Delta threat, how big of an issue is it to the markets as you see it right now?
I think it's a big threat, but I think that more so, I think there's really a gathering of multiple headwinds, right? There's potential income tax increases. There's really perhaps excess enthusiasm in the market at this point, given how valuations have been stretched. And I think there's really just way too much euphoria, in my view, that the economy is going to open wide open. I mean, try to book a ticket to Asia right now. See what's happening in Japan in terms of the Olympics. So I think the Delta variant, as well as these other issues, are going to cause some problems for the market. That's why we've been concerned and why we've been expecting a 10% correction. As Mike pointed out, some of the markets already have corrected 10%.
In terms of, your more traditional safe havens, we were just talking about the 10-year, 1.2%. Would you recommend that investors seek those right now?
No, I don't think so. I think 1.2 is really, first of all, the bond market saying that the equity market is way too optimistic. Secondly, I think it's just probably not the thing to do is to chase down into assets that are already in tremendous buying pressures, such as the 10-year Treasury, 1.2%. Think about that for a second. I think instead what you do is you just do this rotation that I think was talked about earlier this morning on CNBC. There's been a rotation from value to growth, growth to value. I think it's a time to reposition your portfolio strategy with some of the areas that have gone down this 10% area, maybe in the banks, maybe in certain technology companies that have really lagged. I think that's really what you want to do in this kind of market, not panic and just sell everything out into treasuries, because the market basically, even though slowing, is still fundamentally okay.
Yeah, Michael, we have we saw 1.19 we just hit there on the 10-year. Inflation's running at 5.4%. 5.4%,
yeah.
Which is not sustainable, I guess, is the question.
Well, that's the whole point, right? Is it sustainable or is it transitory? As Janet Yellen was pointing out just the other day, if Delta continues to accelerate and you continue to have warnings like they said in Los Angeles, concerned about people traveling to Las Vegas, for example, because of the spike in COVID, that's going to continue to slow the economy. So I think that inflation, even though it is at 5% right now, look what's happening with oil right now. Many of the inflation drivers, lumber down 50%, as was just mentioned. I think you're going to continue to see a pushback on that inflation number. Wait in 3 months, David. That's what's really going to matter. Not so much the reopening number. We all know inflation will be high for the next 60 or 90 days.
Mike, you're a student of market history, and, as you kind of look back to 18 months ago, how do you see some comparisons between what's going on today with fears surrounding the Delta variant with what we saw, at the early stages of the coronavirus pandemic back in, that February, March timeframe?
Well, first of all, I think this is a little bit more of a fear that we're not clear of it, as opposed to a return to those exact circumstances. Nobody really thinks we're talking about global lockdown. We've been through it. The market's incredibly liquid. And also, we were up 100% from the March 23rd low of last year. It reminds a lot of people a lot of what happened after the 2009 market low, right? Global financial crisis finally reaches this crescendo. Markets up tremendously in a year's time into 2010. And then, just as we're up there, there's these excuses to have a correction. Oh, European sovereign yields, that's going to be a concern. Look at Greek spreads. All these things made it feel like, oh, no, we're back in it. We're back in the financial crisis. And we weren't. There was an actual sustainable recovery, but the market just had to digest that possibility that we got a little too over-optimistic on the front end.
How long does that digestion usually take?
Well, back then it took a few months, and you got a 10 or 15% pullback, and nothing says it has to be as long or as deep as that, just because of all the policy stimulus right now. And really, we're dealing with things that we can actually chart very well, as opposed to, I think, back then it was really unclear if you had a proper policy response to some of those issues.
Michael, given some of these dynamics that Mike was just outlining, do you think this is an opportunity to really buy on the dip? And if so, how should investors really be allocating? Should they be buying into stocks that are less exposed, say, to a reopening trade? Or should they kind of take that as a price correction that they can really benefit from later?
So as usual, when economies are basically strong with low interest rates, I think buying the dip makes sense. I think what you have to be careful is, though, the reopening trade is already pretty expensive. Even though they've corrected down and you have stocks down 5-10% in some of these reopening names, they still rallied a ton. In fact, you look at what Zoom's doing today. They know that. That's why they're using their stock to make an acquisition, because their stock has gone up a tremendous amount. So I think what you want to do is make a list of the sectors, the names you've been looking at, and keep that list handy. Maybe you have a list of 20 names or so, maybe 4 or 5 sectors, whether it's healthcare, financial services, technology, and then just watch the market. And when the market bumps down on these kind of days, a 600-point drop, a 1,000-point drop, a 300-point drop, when the market bumps down, you start dripping into some of these names that have been chiseled off because of some of the Delta fear. I think that's the way you position portfolios. That's the way you make money in a sideways market, by repositioning your portfolio when the market isn't sideways anymore.
Shepard Smith here. Thanks for watching CNBC on YouTube.